building secure, stable, sustainable income in retirement with the help of the Vinson Financial Group.
When we customize a full income plan, we hope for the best, but we also prepare for the worst. But every plan and every situation is different.
Get more at retireatlradio.com.
And we are here with CFP and investment advisor Aaron Vincent, CFP Matthew Decker, helping you retire on your terms by addressing three key pillars: tax planning, risk management, and determining your income strategy. My name is Mark Owens. Gentlemen, I need your help. Need you to almost...
Yeah, you do.
You definitely need our help.
Talk me off the ledge, if you will.
Okay.
It's been a wild couple of weeks in the market. You turn on CNBC, you turn on Fox Business, a lot of those breaking news, flashing headlines, the red arrows all pointing down. My friends on the left saying it's the end of the market as we know it. Trump is going to take us into the next Great Depression. My friends on the right saying, all right, wait a minute. This is a speed bump. We won't know what this really means for another 6 to 8 months. For people right down the middle, what does it mean with all this market volatility? And more importantly, what does this mean for our retirement savings?
You know, that's a great question. It's funny, for the last couple of weeks, I've been doing research on the media and how they talk about periods like this. Mm-hmm. And so I went back all the way back to 2005, all the way back. Can you guys remember?
That was 20
years ago.
I know.
You say 20 years ago, I think of like 1980.
I know.
Mm-hmm.
I know. I've had some of those
That
moments recently.
That was 40 years ago.
Hurts. It hurts.
So I went back to 2005, and I just said, show me the worst days. I said this to AI. I used AI to do the research because it's a great tool for research.
Agreed.
And I said, show me the worst days in the market every single year going back to 2005. Best and worst days. And then I want you to pull for me headlines from those days from news sources. And what's so interesting is, so I've got 20 years worth of the worst day, and all the headlines are like the same headline, just over and over and over and over again.
Right.
And it's so interesting how that happens. It's just these cycles just play themselves out. And sometimes it's easy to forget that the media, if it bleeds, it leads.
Yes, sir.
Mm-hmm. And so it's not like there's 1,000 different headlines that are all going to sound as good as each other. No, there's like 7. Mm-hmm. There's like 7 headlines that just continuously play over and over and over again whenever the market's in turmoil. I've got some. I'll read them to you. So 2005, November 15th was the worst day that year.
Okay.
Dow was down 1.7%, 183 points. Stocks plunge as inflation fears resurface.
Take a shot every time we hear the same word.
Right.
All right, plunge, there's one.
That was Wall Street Journal. Okay. Hey, that sounds like a headline that could read today.
Interesting.
Interesting. Okay. Dow drops sharply on economic worries. Reuters. Market tumbles. Investors brace for rate hikes. Interesting. All right, that's 2005. All 3 of those headlines could probably play today.
Right. It's like when you highlight a word and then it pops up like, here's a thesaurus, or here's a synonym for
Once
the
you
same
start
thing.
seeing it or hearing it, or
Yeah.
like you see that car on the road, once you notice that one car, now you see 20 of them.
Exactly.
Now, here's what's crazy. The recovery timeline for that was 10 trading days.
But wait. Stocks plunge.
Stocks plunge.
They tumble.
Dow dropped sharply on economic worries. 10 trading days later, back to even. 2006, May 17th, worst day. Again, a 214-point drop, 1.8% on the day. Dow sinks as inflation panic hits. Stocks plummet on rate hike fears. Wait a second. That is almost the exact same headline as last year. Stocks plummet, market tumbles on rate hike fears. Investors brace for rate hikes. It's like the exact same
All they did
thing.
was impart the word panic.
Right.
Just to up the ante a little bit.
They're just swapping headlines.
That's all they're doing.
So last year, that was Reuters. This year, it was CNBC.
Okay.
So they just flip-flopped. Wall Street shudders, worst drop in months. Recovery timeline, 22 days. 22 days, everything's back to normal. But it's the same headlines. 2007, Dow plunges. There's another plunge. Markets crash. Wall Street's dark day. Investors flee.
Oh, wow. It's heavy.
I know. Recovery timeline, 13 days. 13 days. And that was a 3.3% drop in one day. So that's a big drop in one day. 416 points at the time.
So plunging, panic, fear, worry, and if you happen to be on a week or 10-day vacation, you didn't see or experience or know any of it.
They say dark days, 13 days. That's about how long it takes me to change a light bulb anyway. So
That's right.
2008 is totally recycled headlines. We have tumbles.
All right, tumbles.
We have turmoil.
Ooh, turmoil.
And plunge again.
Plunge. That's 3 for plunge.
Tumble,
3 years in a row.
turmoil, and plunge. And this was a big drop, 7.8%.
In a
That's
day.
significant.
733 points. This one took almost 11 months to recover from. Now, this was 2008.
Okay.
So
Yep.
that makes sense. We have a bucket for that one.
But even still, pause there.
Yep.
11 months. Like, I don't want to downplay. 2008 was not a good year. If you just retired or you were about to retire in that day in 2008, I mean, that affected you big time. So the timing of that really could have been bad for you if there was no plan involved. But if we just think about zoom out, we talk about this all the time with prisoner of the moment, prisoner of the headline. If you zoom out and realize that panic, fear, turmoil, tumble, plunge, and even in the worst case scenario that you just read, Matt, 2008, it was barely a year and it was all back to where it was. And then I think where you're going next, I don't want to steal your thunder.
Steal it.
But
You can steal it conceptually, and I can provide the receipts.
if we use 2008 as an example, so what happened in the next 2 or 3 years?
Yeah, I got the next 5 for you.
Perfect. Let's talk about that.
So the next 5 years, 2008, October 15th, 2008, 7.8% in one day. That's a big drop in one day. Let's not downplay the fact that that's a
Yeah,
big drop
that
in one day.
hurts.
Yep. And those headlines are probably the first time that those headlines have been appropriate. Right. Everything else was like a 1% drop in a day. This one is significant. The next 5 years of growth in the Dow, 2009 was up 18%. 2010 was up 11%. 2011 was up 5%. 2012 was up 7.3%. And 2013 was up 26%. So the headlines are screaming at you, there's a crisis. Look out. Dark days ahead.
Right.
The market is tumbling. Rate hike fears. And yet, 89% growth over 5 years. So if you are someone who watches the news and you're getting your information from the news, you should know if it bleeds, it leads.
100%. And now, more than ever.
More than ever. This 24-hour news cycle,
Right.
They need your eyeballs on that screen so that they can sell you pharmaceuticals. Because
Yeah.
that's what it's all about.
That's exactly right.
So
Nail on that.
if you're just watching the news and you're listening to those headlines and you don't have a plan, oh my gosh, like you're in emotional turmoil. You're emotionally tumbling. You're in emotional turmoil. Your emotions are plunging.
And they're
because-
sinking.
And they're sinking.
And there are dark days ahead.
Dark
And you're
days ahead.
panicking.
And you're plunging.
And you're probably going to make an emotional decision. We see this
How can you not?
all the time. Yeah, how could you not? If that's what you're doing, if that's what you're subjecting yourself to, and that's really what it is. You don't have to do that. You could choose to just avoid that whole discussion, and you'd probably be better off for it. Because if you're listening to the headlines and they need you to be unsettled, because if you're in an unsettled state, you're more malleable, well, then you're going to miss the recovery. You're going to miss the actual growth that happens in the market when you can stay the course.
And so big picture, Mark, you started off by saying, hey, guys, talk me off the ledge.
Right.
We got all this stuff happening all around me. Well, all that Matt just described, even if we zoom in on 2008, if you just didn't do anything, let's just pretend that you were invested in the S&P, right? But you stayed invested. If you didn't do anything, yes, 2008 was a rough one. From memory, I think the S&P was down 40 to 45, maybe 43% in 08-ish, something like that. All right. Well, Matt just mentioned that the next 4 years or 5 years later, it's an 89%. So even if we don't use compounding interest, even if we just stay simple for this conversation, if you didn't do anything, you just stayed the course, do the math, you're down 43, then you're up 89. You're up almost 50% in just a few years, even though you lost 40 and you panicked in the tumble, plunge, plummet situation.
You only lost if you succumbed to the fear
That's exactly-
and made an emotional decision. You
Exactly
only
my
lost
point.
if you actually went in there and started making trades.
That's exactly my point. There is no losing unless you, and this is why what Matt said a second ago is so critical. If you've got a plan, I don't just mean, like, I think sometimes people think about a plan as something that has already predetermined everything. And so you're going to know that 08's coming, or you're going to not feel the emotions because you have a plan. That's not true. We're still all people. But what a plan does, it helps put everything in context and perspective. So you're going to experience some market turmoil like there was in these dates that Matt just read off, but you're going to have a place to put it. You're going to have a place to understand it, a context around it to know what this actually means. So even though you're feeling the way you're feeling, I'll be honest, like, I was nowhere near retirement in 2008, and I was still kind of like, whoa, what's happening? This is a little bit scary. So you can feel what you feel, and a plan won't necessarily change how you feel in the moment, but what it does is it puts it into context for you to make good decisions. You can kind of see around the corner and see what's the cause and effect of this, and going back to what we like to call durable portfolios. That's the most important thing. I'm actually not that excited to help a client build some kind of sexy portfolio that they can go brag to all their friends about the returns, 1 year to the next. That's not the main goal. And I hope that's startling to our listeners out there, because you might be thinking, well, what would I hire you for as an investment manager if you're not going to give me those crazy big returns? Well, hear me out. I'm trying to build for you a durable portfolio, one that you can stay the course. One that in 2008, you don't freak out, panic, and do all the things that the headline said you should do and change your whole portfolio overnight. If you can stay the course, guess what you will get? You will then get those big, fun, sexy returns, like up 89% in just a couple of years, because you were already there. But you can't do that if your portfolio or your lack of a plan has you all over the place psychologically and emotionally. And I think media, I'm going to get on a soapbox here, they know this. We joked a second ago about because they're trying to sell you pharmaceuticals. Yep. Well, that's not
I wasn't
true.
Joking.
That's real. But it's even broader than that. It's more than that. If they can just get you listening, then there's going to be some commercial, something they can sell you. And so just seeing what's happening, taking a step back. Mark, get off the ledge.
Yeah.
It's going to be okay. And we've got some more things to talk about that.
Okay. 770-741-0120. Again, 770-741-0120. I'm just as guilty as everybody else. I doom scroll. I watch the news. I see social media. If somebody calls the Vinson Financial Group right now, somebody calls you, they're worried. They say, look, my emotions are sinking. I feel like my plans are plummeting. There are dark days ahead because of these sharp drops. Aaron, Vincent, what are you telling somebody about their retirement strategy and their money right now?
Well, I'm asking some questions first because I want to get to the point, because we have to get past the headlines. What are you actually worried about? Because the first thing I'm going to say is, well, what has happened to you specifically? Like, let's talk about your portfolio and your situation specifically, not some broad headline that millions are listening to and getting kind of caught up in, but you specifically. What is your portfolio down, or what are you concerned about? Is it that your lifestyle is at risk and all that you've worked for the past 30 or 40 years is at risk? Okay, now we're talking about something specifically that we can actually address. And so what I'm saying is this, is it doesn't have to be that way. Now, let's sit down and talk together about the plan we could put together to help you offset some of these fears and concerns. That's where we're starting.
I think it's interesting. You talked about 2008. We talked about some of the big drops and the headlines, and the idea of that durable portfolio is so key, and it is the most important piece of the puzzle, because if you can't stay the course, you're going to miss all of the benefits of being exposed to risk. Mm-hmm. There's a saying that I learned from the guy who taught me everything. His name is John Solomon. He lives out in California. He's a genius. And he told me this when I was, probably like 25 years old. He's like, Matt, guarantees are expensive and risk is free. And that's why when you take risk, you can actually, without risk, there's no return.
Right.
Guarantees are expensive, risk is free, and without risk, there's no return. I'm like, oh, okay, interesting. Well, that applies in life. It certainly applies in the market. If you're not willing to take risk, you're not going to receive a return. And that's probably why you're invested in the market, right? You want to see your money grow. In order for you to see your money grow, you have to be willing to stay the course. And this gets back to these big days, these big drops in the market that we've kind of highlighted. Aaron, I know you know the answer, but I'm just going to ask you because it's fun to talk to you versus talking to myself.
I'm right here.
Okay, cool. How close do you think the worst days are to the best days on a yearly basis? If we just talk about the market ups and downs, how close are the best and worst days?
So close.
So close?
They're so close. I mean, strikingly close.
Yeah.
I don't know what other word I can put in there, but they're like, what you're saying, Matt, is some of these stats you just read, the worst of the worst, the down, down, down days. How many days away are the best up, up, up days?
Yeah.
And they're very close.
How close do you think it was in 2008? Now, this I don't think you know the answer to.
No, I couldn't know, but I'm going to go with 3 to 6 months.
2 days. 2 days. Yeah. Now, in 2008, the best day came before the worst day. So that's not. Okay. So you're not in jeopardy of like emotionally reacting to the best day and missing. That's not what we're talking about. But I've got a lot of other days here. So
let me give out that number real quick. 770-741-0120. 770-741-0120. Again, 770-741-0120. If you've got concerns about what the market is doing to your retirement strategy, or maybe you're thinking this is offering some great opportunities, we invite you to call the Vinson Financial Group. Take advantage of their no-cost, no-obligation consultation this weekend. And we know you got a lot going on this evening, so even when you make the phone call, we'll get you off phone in just a couple of minutes, a couple of quick pieces of information, a name, phone number, email address. What can we help you with? And then we'll get you on the schedule to sit down with Aaron, to sit down with Matt, and the team at the Vinson Financial Group. Again, 770-741-0120.
So 2009, the best day that year was up 6.84%. The worst day was down 4.24%. Okay. The gap between those 2 days?
Couple weeks.
21 days.
3 weeks, yeah.
So if you emotionally react to the worst day, you are in jeopardy of missing the best day. That's 2009. 2010, the gap was 30 days, down 3.2%. The best day that year was only up 1.65%. So it's important to get those, because if you have a year where everything's generally down, you have to be exposed to those good days.
Totally.
And we're within a month.
So
2012 was long. That was a year. That was a whole year. But you got to be willing to stay the course.
Right. So who are we talking to? I think it's important. Like, people are listening in, and everyone's affected by the headlines, but drilling it down one layer closer, Mark, to answer your question a second ago, what am I telling someone who calls in? Anyone who has done the bulk of your retirement savings. So, and maybe for you that's $500,000. Maybe for you it's $3 million. It doesn't really matter how old you are necessarily, but if you have put the bulk of your savings, if your years of saving, preparing for retirement, there's a saying that we say around the office all the time, and it sounds a little funny at first, but it's so relevant right now. But that is this: losing money can hurt you more than making money can help you. If you reach a certain point in your life, in your savings, in your career, in your retirement planning, and a 10 or a 20% drop in your portfolio hurts you worse than a 10 or a 20% gain in your portfolio. And what goes along with that, a rhetorical question that I sometimes ask is, why would you sacrifice what you currently have and you currently need, this money that you saved, for something that you don't currently have and don't currently need? So you've done the bulk of your savings already. You've gotten most of the way there. Well, those conversations are critical, because what Matt's spelling out here with all these stats and data is, if you're at that stage of the game and you're tempted, this is who we're talking to, you're tempted to say, the stakes are getting too high. It's getting too hot in here. I'm not sure that I can stomach some of these headlines anymore. Those red arrows pointing down day after day, a few days in a row, I start to feel the heat. I'm tempted to change, overhaul my portfolio. If that's you, if you're having those thoughts, then you got to call us, because you need to know the cause and effect of those decisions. I'm not even telling you that we have the crystal ball answer for you, but what you need to know is the cause and effect of executing some of those thoughts. Hey, move me to cash. It's getting too crazy in here. It's in my IRA, so there's no tax consequences of it. I got to get out for a while. I'll think about it and I'll decide when to get back in. I got to do some thinking and some planning and some researching here. If that's you, give us a call, 770-741-0120.
You may not know it, but if that's you, you just turned into a market timer. I got to get out, time to go to cash. Now you're a market timer, and market timers historically guess right less than half the time. Less than half of the time, if you're trying to get in and out and time the market. This is a Dalbar study that's published every single year. You can Google it. You can probably find a free version out there if you'll Google it. Dalbar study studies retail investors. When they get in and out of the market, how often are they correct?
And they've got to be right twice. You've got to get out in time,
right?
And you've got to get back in time. And to get it right twice without having a catastrophic failure is even more rare.
When the best and worst days are sometimes weeks, days apart, you've got to get it right twice. And the research shows every single year, the guess right ratio is somewhere around like 25% to maybe 35%. And you've got to be right 2 times in a row, which means you really have no shot of doing this well long term.
No.
You just don't, which is why you have to have a durable portfolio that's built for you. It's going to focus on 2 things. Number one, what's your emotional appetite or your emotional capacity for risk taking? That has nothing to do with your plan. That has nothing to do with your lifestyle that you're living or how much money you've saved. That's just you and how you feel and your disposition.
It's also not good or bad.
No.
Some people think, well, I'm low risk. I'm kind of embarrassed about that. No, you need to know that.
No. Are you a cliff jumper? Like, do you like jumping off cliffs into the ocean? I don't. But if you do, you have a high appetite for risk. Okay, great. Like, that's cool. Send me the videos. I want to watch. Right. I don't want to do it, but I want to see you. Mm-hmm. That's the first thing it's going to look at. The second thing is, how much risk do you need to take? Getting back to what Aaron just said, why would you sacrifice what you already have for something you don't have and don't need? If you've already done the bulk of your retirement savings, if you're already well on the path to being able to retire when and how you want, now you're at the stage in the game where taking more risk doesn't even make sense. Even if you have the appetite for it, you may not need it. And if you don't need it, more risk is only going to do, I guess, one of two things. You're going to die with more money, or it's going to jeopardize the plan.
Yeah.
Like, those are the two outcomes. Most people get to a point where more risk doesn't mean an increased lifestyle. It just doesn't. And so now you're taking risk, and what's the payoff for you?
FOMO does not improve anyone's life.
Drives me crazy.
It just doesn't.
My wife makes fun of me all the time. I've got the worst FOMO. You know, we said it at the beginning of this segment. You addressed at the Vinson Financial Group 3 key pillars: tax planning, income strategy, and risk management. 770-741-0120. We invite you to reach out to the team right now. We know you got your phone right beside you. You can make the phone call. Even if you make the phone call and just hang up so you got the number locked in, you can call us back on Monday. That's fine. But it's important to make the call to get the number. 770-741-0120. Some people are screaming that the sky is falling. On the flip side, there are some people that are saying these are some of the best opportunities.
Absolutely.
That you're going to find in a long time.
That's true.
Right now. Do you agree?
Absolutely, I agree. Now, that doesn't mean that there's some secret investment out there that's going to always work for you. But anytime there's periods of high volatility, when I see volatility, I'm thinking opportunity. There's always opportunity in periods of high volatility. And we've spent the bulk of this time talking about your market-linked investments, your money that's considered at risk. But how much of your money should be at risk, Aaron?
That's a good question. Different for everyone.
But it's not all of it.
Not all of it, though. No. You need to have 2 pockets to pull from. So this is a very powerful but also simple kind of strategy or principle, and that is, it's good to have at-risk money, right? It's good to have money that's growing. You need to outpace inflation and outpace all the future cost of living and all that kind of stuff. That's important. To Matt's point a second ago, you've got to have some money at risk to get any kind of returns. It just is what it is. But that money inherently, by definition, means that it's going to be up sometimes and down sometimes. All right, well.
And you don't have control over when it's up or when it's down.
Correct. But when you graduate or transition to, now this pile of money is now my income plan. This is now my nest egg that's going to be kicking me off an income. Well, what you really have to avoid, and this is what we specialize in, is having to sell those up and down investments when they're down to create income for yourself. How do you offset that? Have some money that's safe, that even when the markets are down, this money over here in this pocket is not down, and you can sell some of those to create income. And now you've got uncorrelated assets. They behave differently in the same markets. And now you've got a durable, insulated portfolio because you have options. You can be nimble. It's one of the most critical aspects to I'm using air quotes, a plan. If you don't have that incorporated into your financial situation, you actually don't have a plan.
If that's you, you've got the bulk of your money in the market and you're trying to decide, do I sell? What do I sell? I got to create income, but I don't quite know how. You really need to call the office, 770-741-0120 or retireatlradio.com.
Home office in downtown Woodstock by the team of the Vinson Financial Group. They can meet you at a time and a place that's convenient to you and your schedule. 770-741-0120. Or, of course, we invite you to go online, retireatlradio.com. You can put faces to the voices that you hear every weekend right here on Retire ATL. And by the way, Aaron Vincent, Matthew Decker, these are the gentlemen that you're going to talk to. They're not going to push you off to some sub-advisor that's from Chattanooga or Knoxville or Mobile. No, they live here, they work here, they play here. You're going to meet Aaron, you're going to meet Matt with that first consultation. 770-741-0120. Quick break, back with more. This is Retire ATL. It's all powered by the Vinson Financial Group.